Welcome, everyone. I'm Mike Mershazadeh.
And I'm Ashley Ward.
And you're listening to the What Matters podcast, and our mission
to spotlight top RIAs, wealth managers, and investment professionals who are redefining wealth management.
Join us as we dive into their journey, strategies, and insights.
Whether you're an investor or an inspiring pro, this is for you.
Get ready for impactful conversations on the What Matters podcast. Welcome to another insightful episode of the What Matters podcast. I'm your host, Mike Mershazadeh.
And I'm Ashley Ward.
And today we have our distinguished guest joining us, Mike Minter. Mike is Chief Investment Officer at Financial Synergies, Wealth Advisors in Houston, Texas. As CIO, Mike develops and directs the firm's overall investment strategy and supervises the portfolio management department. Mike also became a shareholder of Financial Synergies in 2013. Welcome, Mike. Thank you for joining us today.
Yeah, don't date me that much, man. Yeah, no, happy to be here. Thank you.
I promise you it wasn't a typo there. I'm still dated back into the 90s, right?
Yeah. Hey, man, I'm getting older, I know, but man.
Well,
I don't feel
Mike,
young.
We're excited to have you with us today. Let's jump right into your story and your background and really what led you to where you are today.
Sure. Yeah. Gosh, it was kind of a weird path to get here. I was studying to be a physical therapist in college. I was kind of going down the sports medicine path, and I was minoring in business, and I really felt myself gravitating more towards business and investing. And my parents had opened up a mutual fund account for me, like I'm sure a lot of parents do back when you're a teenager. And I think it was a Vanguard account. And I remember just being astonished by the compounding effect and just, investing little amounts and watching that grow over time. And so I already had a passion for it. And then when I got into college and started taking the business classes, although they were a minor, I just really fell in love with it. And so by the time I didn't want to switch gears midway through my degree and just go a whole nother route. So I figured, well, I'll get out with this degree, which was a little bit more sports medicine oriented. And rather than I was planning on going straight into, physical therapy school or something like that. But I just really didn't want to go that route anymore. And so I had a family member actually working for a company called Invesco. I don't know if you guys are familiar with that big. At the time, it was called AIM Investments, and they were kind of a conglomerate with Invesco, and then Invesco kind of gobbled them up, I guess. And so I was working for Invesco right out of college. Like I said, I had a little bit of a hookup through a family member and was fortunate enough to get in over there. And so I got some licensing over there and things like that. And so that just kind of furthered my investments career. I was mainly on the operations side there, mutual fund operations, but I was learning a lot about the business. And over time, I was working with a lot of brokers and advisors at the time. And I really found myself wanting to be more on that side of the aisle, so to speak. So wanted to work with clients, or at least be in the business of helping clients directly rather than on the product side. And so I started kind of looking around, and luckily enough, Financial Synergies, Mike Booker, the founder and still majority owner, we found each other kind of online, one of those online kind of match making services at the time. I don't even remember what it was now, but so we linked up and we hit it off, and so he hired me on as the director of operations at the time. This is almost 21 years ago, and then really let me kind of find my own path within the company. And it was very small at the time, but over the years, I really started to gravitate more towards the investing side of the business, got my CFP, and really started to dive in there. And that's kind of where my passion has been ever since. And so I love what I do, and I really couldn't think of anything else I'd rather be doing.
So let me ask you this. So you were at the company, about close to a decade before you became a partner. Is that correct?
That's right. Yeah, exactly.
And how did that come about, if you don't mind me asking?
Well, Mike was very forthcoming there. I mean, he already had a plan in place. He really wanted to bring up the younger guys. There was two other people in the firm with me at the time, Heath Hightower and Brian Chisha, still with me today. We're all very tight knit, and we've been together for 20 years. And he always had a plan to, a succession plan in mind. Maybe not exactly how that was all going to work out, but from day one, practically Mike said, "Look, I want you guys to be shareholders." And so we devised. I mean, he really devised the initial plan of first, this 10-year period where you're kind of vesting, and then you've got, all of a sudden you've got this percentage ownership in the company. And then there was a period of time where, that played out. And then we subsequently purchased more shares in the firm. And so now within the next year or so, there will be another transition where we'll buy out some of the remaining shares. And so it's been kind of a whirlwind, but just unbelievably gracious for the opportunity I've gotten. And now I feel like one of the older guys. I'm 46. I feel like I'm at the firm. I'm old. So we have so many younger people working for us in their 20s now, but we now have the opportunity, to in the future bring on the younger generation of shareholders. And so, we're gonna make that happen. And so that's been really cool. That's actually been one of the more exciting things in my career, is kind of thinking through that and seeing how we might make that work in the future for the next generation. And it's all thanks to Mike Booker. I mean, he set this in motion 20 plus years ago.
So let me ask you this: with how many total advisors are at the organization at this point?
Oh gosh, I think we have 11 or 12 advisors now. Don't quote me, but I think we're around there, 11 or 12. We have 19 total people, and when I first got started, it was, oh man, I think there were 2 or 3 of us.
Wow.
Wow.
So it's grown a lot. It's really amazing to see. It's been a lot of fun. And now the 3 of us and Mike, we're kind of, I guess, the older guys at the firm now. And so we're, a lot of our time is now not only spent on our job, the job description we have, but also managing the business and people. And so, there's just a whole host of challenges to come with that, but it's also a lot of fun.
So I got a last question for you before Ashley delves into her set of questions. I know she had some with having these new and upcoming advisors in the organization. Obviously you guys are training them, taking the organic approach. When you had gotten to the firm, you said there was just 2 or 3 advisors. How big was the AUM there to what it's exploded to now?
Yeah, when I started, I want to say we were around 130 million, somewhere in that vicinity. And so to be at 1.3-ish billion now, it certainly didn't happen overnight, obviously, but it's been a heck of a ride. I mean, just all the cool things that come with that, but also the challenges. It keeps you on your toes, because you kind of, it's almost like you're morphing from a practice into a business, at some point, and you find yourself having to, develop the infrastructure to be able to handle that. And so that's a big transition. So some firms really don't ever kind of get over the hump there. And we had to make some real strategic moves to make sure we did get there. You have to have the right staff in place. Departmentally, you have to be divided the right way. Those are all these things that you have to be able to do to really make that transition. And we've been very fortunate. Yeah.
Thank you. And were there any pivotal moments or experiences that really, shaped that part in your career? Was it you guys hit a certain AUM and you had to make these changes to reach the next goal, or was there any certain just moments there within the organization that really determined the future?
Well, I think at some point, you have to make a decision to not try to wear every hat. You have to, at some point, start bringing in specialization or more closely defining roles, because, when you're young and you're starting out, you're doing everything. You're filling out the paperwork. You're doing all the operations. You're doing the investments. You're doing the relationship management. You're doing it all. and that's only sustainable for a certain amount of time, a certain amount of AUM, a certain number of clients. And so you have to really make a kind of a concerted effort to start to more define those things out. And so that's exactly what we did. The other thing I think that we did was, we've always been, financial planning investment management firm, but I think that at some point, it was probably around 2012, 2013, maybe, we really started to develop out, this idea of more of a holistic financial planning and wealth management approach, where we can really bring in, a lot more strategic tax planning, estate planning, insurance. Not that we sell insurance or prepare tax returns, but we started incorporating a lot more of that. And so we have some real specializations there, on our team that we didn't have before. And we have great talent. I think the main thing that we have gotten right is just hiring really great people. And so, that was a big part of, I think, being able to kind of springboard to the next level. There's these kind of arbitrary numbers you read about in these case studies, like, but I figured out real fast, they're not arbitrary. They're actually based on all these benchmarking surveys and things that firms really experience. But, you hit 500 million, for example, it's a plateau period for a lot of firms. I mean, there's infrastructure and things you have to do to get beyond 500, and then you get to 750 and you're at the same thing. You're like, man, we were crushing it. And now we're kind of plateauing out, bouncing around the 750 mark. And then the same thing at $1 billion. So it's just, there are universal truths, I think, in the business that we have experienced. Yeah.
And you guys have, I'm very impressed with the way you guys have grown this company. Has it, just all been organic? There's been no acquisitions of other firms?
No acquisitions whatsoever. No M&A activity. We have toyed with the idea, and I guess never say never, but it just, it's not really in our DNA to do things inorganically. I think at a certain point, you probably, if you want to compound growth after multi-billions in AUM, I get it. I think you almost have to go there. It's very difficult to do that organically, especially when you're just in one market. So there may come a time where that has to be on the
throughout
table.
Your career,
but for
what
us,
valuable lessons have you
organically
learned
right
along
now
the way
suits
that
us,
you
and
believe are crucial
we're
for
pretty
aspiring
fiercely
wealth
independent.
managers
We've never
entering the
really
field?
wanted to bring in any outside, money, or, we don't have any debt. There's there's nothing like that. So we've tended to kind of shy away from that and really want to do it ourselves. So, but again, I get that there may come a time where we may, change our tune on that.
Gotcha.
Give it time. I think a lot of people, I know it's a lot of younger people don't want to hear that, but so much of this business is just absorbed over years and years or decades of experience. Just being able to talk about things as if they're second nature, these concepts and ideas. That really is the most valuable lesson I've learned, is that nothing replaces experience. And, this is a business of experience a lot of times, and you just have to give it time. This is a wonderful career for any young advisor if you give it time and don't try to rush it.
Yeah.
But it takes just that. It takes time. And that's on the investment side. That's on the, the wealth management advisory side. That to me has been the biggest takeaway. And I love it. I mean, I love, having the years and experience behind me now to where, you do have that confidence in yourself to really be able to answer any question that's thrown at you. And that just takes time,
Right.
So that's what I would tell any young person entering the business.
And so let me ask you this. For example, there's been challenging years such as 2008, and I might be wrong, it might be 2009, 2022. How did you guys, how are you guys able to navigate those years. They were pretty exhausting for me being an investor in the market. I could tell you would have hated having me as one of your clients. So I was that guy. Right. So I wanted to, ask you, how did you guys get over years like that? Especially, what I was going to ask is, you're getting in there and, 2001 or 2002, and then you guys have this nice, growth, right? And then all of a sudden 2008 or 9 hits, and some things were going down 80-90%. So, well, actually, right when you joined, that was right after the tech crash. So you have 3 really pivotal events to talk about. Can you share some of your insights there and what you guys did?
Yeah, sure. So I think number one, most importantly, is the ability to keep people in their seats and not do anything drastic, because that is the death knell, I think, to any financial or investment plan. It's only as good as you actually implementing that plan. So you can do all the planning on the front end, and this is the perfect allocation, and you're running the Monte Carlo, and you're in perfect shape, and all these things, and then you go and sell out of everything at the bottom of the market in '08, and that plan it's out the window. It all of a sudden you've just derailed it, and that is behavior you can control. You can't control the market. You can't control returns. You can only control your own behavior. And so that's what we really try to instill in our clients is, look, this is why you hired us. Maybe years where you feel like, man, I'm just not really getting a lot of value here. Maybe I'm not, maybe they're questioning things. And this is it. This is why you hired us. We're going to keep you in lane. We're going to keep you invested. We're going to get you through this and hold your hand through this. And that's step number one. You have to keep them in their seats, because if they make a dramatic move like that, and we've seen it. Unfortunately, we kept the majority of our clients, and no doubt about it. And we were on the phone constantly, in those crisis periods, and doing everything we could to just keep people calm and rational. You can't keep them all, but I think we did a good job. And so if you can keep them invested, you get through those rough times, you get on the other side, and you're going to get through it, because we studied the history of markets. We know they recover every single time, without question. And most of the time, the exact point of capitulation for people is exactly when you shouldn't sell. That's usually around the bottom, frankly. And it's it's the worst timing possible. And so if you can keep them invested, you're head and shoulders above most firms, frankly. The other side of it, I think, just from a business standpoint, is I think you have to. For us, we never stop prospecting. We never stop. We have to bring on new clients too. I mean, it's not just about keeping your existing clients. One of the things that helps you get through really lean periods like that is bringing on new clients. It seems counterintuitive that you would, choose those times, crisis times, but it can actually be a really good time to go out there and grab new clients that maybe are not happy with their advisory firm. They're looking around. They're not getting that level of communication, or maybe just not getting a good experience. Who knows? But we've actually experienced very good flows in those years that have really helped us stopgap that, because the market's not helping you out. You're hemorrhaging AUM because of the market downturn, but you're also bringing on a lot in terms of net new assets, and that can be a huge deal. And so that's something that we always do that, but particularly in the down years, it's helped us a lot. And that goes specifically for 2022. 2020 was, the pandemic year was kind of weird. It was just very short-lived. It was so dramatic. It was that V shape, you're down and then you're back up, and before you know it, you're in positive territory. So that was a little weird. 2008 was definitely the worst in my career. I think it was probably the worst in a lot of people's careers, because it just didn't seem like there was any end in sight. Because you got hit in '08, and then you got hit even worse in '09. And that I think that just really shook a lot of people, and still shakes a lot of people thinking about that period. But we got through it, and again, we were, I think, successful in keeping people in their seats for the most part. And I think it taught me a lot, because I was still relatively young in the business at that time, and it taught me a lot about the good times don't just keep rolling. And I learned that I did learn that very quickly in my career in 1999. I got out of school just in time for the tech crash, and you thought nothing bad could happen, and then all of a sudden 99 and 2000 and 2001 and 2, so I learned very quickly that you're high flying and then you're not. So just this business can be very up and down, but I think if you just understand the nature of markets and that you're going to get through this, it just doesn't even faze me anymore. I just, I've seen a lot, and I know that we'll go through other just horrific downturns in my career, and that's okay. We'll get through it.
Yeah, and in a competitive landscape, how does your firm manage to differentiate, financial synergies and create a unique value proposition that resonates with clients, as opposed to other firms?
Yeah, so I think we're really big on just client communication and touch points, and really, providing what we think is a really great client experience from top to bottom. We do bring a lot of things to the table in terms of holistic planning. I know a lot of firms talk about that, but we do execute on that. There's really nothing we can't do. So we have, even if we, don't have necessarily an estate attorney on staff that can handle that side of it, we have great strategic partnerships in Houston, great CPA partnerships. There's nothing we can't do in terms of bringing it all together. And so we really want to be looked at as the quarterback in our clients' financial lives, and come to us, be that first call. We don't think there's anything we can't handle, from charitable giving on down to the investment side of it, tax planning and insurance planning and other. And I think in terms of the portfolio side, we think of ourselves as a solution provider. I mean, we're not trying to box anybody in and say, you got to be in this cookie cutter, and if you're not, you're out of luck. We're solutions oriented in terms of our portfolios. There's nothing we can't buy. There's nothing we don't understand. So we may have a core strategy that we want to accomplish, but if that requires going outside the box, maybe this client needs private equity exposure. Maybe this client needs structured notes for whatever reason to achieve their goals. That's what we're going to do. So we will customize it to the client for sure. So, I think those are differentiators. I think at the end of the day, though, people do have to like you. We are humble. We really promote that in our business. We want people who are hungry, but they're humble. And just be nice and treat your clients well, like you would treat a family member, and
yeah,
sometimes that's lost on some advisors, but that's a big deal with us, and you will not make it at our firm if you're not providing that.
I like that. And let me ask you this. Speaking of you guys having a very culture oriented firm there, a lot of what Ashley and I have seen, and I think everyone at Rise, and probably yourself, has seen in the industry, is and personally, I have a lot more respect for a firm like you guys that have $1.5 billion to $2 billion in AUM than these other firms out there that have 4.5 to 6 billion AUM. And it almost seems like what they do is they go out there and they bring on like a lot of these advisors that kind of run autonomously under their umbrella, right? And so it's never really, their advisors are always just kind of selling themselves. They're never really selling the company that they're at, right? And so ultimately, with you growing your company the organic route, how have you been able to keep your guys on board from saying, hey, listen, we could be jerks and we could take that AUM and we can bounce, right? It's obvious that the clients like you guys as a firm, and their advisors are secondary. I know with my firm, I've been bounced around from 3 different advisors, partially because I've maybe scolded them a couple times, right? So I've been passed off. I think I'm on my third one at this point. But I think with that being said, when it comes to your organization, how do you guys keep your newer guys intact there from not thinking that the grass is greener?
Yeah, it's tough, Mike. I'm not going to lie. I mean, it's a competitive landscape. It's gotten more competitive. I think, in the last, few years in particular, you're even seeing wage inflation. I mean, it's high demand, high, these are really sought after positions. So we get it. and we've been very fortunate for the most part to keep all of our people. You're never going to keep everybody, and that's just a fact of a growing business. But yeah, you hit on a good point. You see so many firms that have this kind of siloed effect where, we kind of refer to them as silo little businesses where they might bring on an advisor and their staff, or, and they're kind of running autonomously within the firm. They're kind of doing their own thing. The firm may provide some infrastructure, but even oftentimes you'll see them doing their own investments, with their little silo, and that's how they run it. And that's fine. It's not for us, and we've never wanted to do that. So we've really made an effort to foster this team environment, institutionalize the firm, where clients come in. Let's face it, they're always going to gravitate towards their advisor. I mean, that's your person. That's your, you're going to want to speak to them, and that's the relationship manager, and that's all good. There's no that's the way you want it. But you also want them to know that there's a Financial Synergies team behind the advisor. It's not just the advisor. We have a whole team of planners. We have a whole team of investment professionals, operations staff, and we all contribute to that client's experience. So, I think it's understood that, yes, that is your advisor for sure, and you want it to be that way. But this is Financial Synergies Wealth Advisors, and you're a client of the firm. And so we've made that very clear, I think, to clients, but also our advisors. And I think in terms of keeping great advisors, I think you have to really make an effort to get it right on the front end. If you hire somebody who's just more geared towards being an entrepreneur, and I want to do it all myself, and it's my way, those just really aren't going to fit in very well at our firm. Right. I mean, don't get me wrong, we want future shareholders and all that. We want them to be owners. We do. But if it's all about you and not the team, then that would be a challenge, And so I think we've done a good job at really vetting that on the front end, and we're very fortunate. We've got fantastic advisors. But I also think that you have to provide a career path and let them see that, look, it's not just get in and I'm an advisor and that's all I'll ever be. There really is a track with our firm, and it's very well laid out. And now we're even providing a track to equity ownership. And so I think those are pretty powerful incentives. But we're realistic, and I know that will not necessarily keep everybody at the firm. But we're okay with that. That's the challenge of running a business. I think that's universal. There's really nothing you can do the best you can, but at the end of the day, you will lose people. But we're going to do our damnedest to keep everybody that we've got with us and grow the firm with great people. Yeah,
I like that. It looks like you guys have done a good job with that thus far. And, I know through experience, you can't keep everyone. I've managed to keep Ashley for around 7 years at this point. So,
good track record. I like it.
Yeah. Oh goodness. Well, looking ahead from what perspective, what transformation technologies or trends do you anticipate will shape the wealth management industry in the future?
It's hard to ignore AI. It's one of those things that is already. I can't even imagine. I'm not a tech guy, so I don't. But I can't even imagine where that's going. If you look at where it is already, you had the first version of ChatGPT. Now they're on their second or third. I mean, the technology is just expanding and compounding at an amazing rate, and so where that's going to be in 5 or 10 years, I can't even imagine, but I know it's going to have an impact. Now, I don't think, we're not one of those firms that think it's going to take our jobs and, financial advisors. Well, that's not going to happen. I think you could have said the same thing about, TurboTax and not need the CPA right. And all those things. But the reality is people want good advice from human beings, and I don't see that changing. I am that way. I could do my own taxes. I have a CPA. I mean, I'm perfectly capable, but I don't want to do it. I want to have a professional looking over my shoulder, and so I don't think that's going to happen. But you're already seeing AI now having its effect on the systems we already use. So if you think about, even Zoom, or something like that. Now Zoom's got an AI component. You've got all these things that we use every day now developing their own AI component based on the new technology that's out there. So it's not even that you have to just jump on and use ChatGPT for everything. It's going to be implemented in the systems you already use. Outlook, for
Right.
example, things like that, where it's going to become, I think, just critical that you're using it to be a more efficient firm. So I think it's going to allow us, frankly, to run a leaner, more efficient firm in the future, much more so than we can even today. And so that's exciting. I think I'm more excited about it than anything. So that's one thing, kind of from a technology standpoint. I think, from a trend standpoint, I think technology again has brought the ability for firms like ours to really tap into alternative type investments, private type investments that were pretty closed off. I think you have to use them in the right doses. You don't want to go crazy on this stuff, but I think if you use them in the right doses, they can be effective. But we now have very efficient exposure to these things where, when I started, that was just not even in the ballpark. You just, and that was really reserved for the ultra wealthy. And that's just really not the case anymore. I think, it's kind of been democratized to an extent where we have access to these things that we just didn't have access. So I see that trend continuing in the future. I also think that RIAs like us are going to continue to expand our service offerings, and expand that value that we bring to our clients. That's been an ongoing trend, I think, for a number of years.
Yeah, you know what? Here in Arizona, we have driverless Ubers, right? It's called Waymo. I don't know if they have if they're out, if they've expanded out your way yet. But it's crazy. Yeah.
Yeah, and that's just an example of, where are we going to be in 10 years from now? If you just take that, is every Uber from now on, in the future going to be driverless? It's quite possible. Are we going to be, driverless, and your car's driving you into work and you're on your laptop? I mean, I think that's a very real possibility as well.
Yeah.
If I just think about the since the pandemic, we're still semi-remote. So, I'm working in my office right now, and 3-4 years ago, that really never happened. We just were not even set up for remote. Even at our house, we just really didn't even have the capability to do it effectively. So if you just think about that, just in the last few years, just from the pandemic, what does that look like in the future? What does the office environment look like? I mean, we still want to have a physical office, the camaraderie and all that, but I think you're seeing a dramatic shift in how firms are thinking about real estate expenses and what they're going to do in the future. Do you really want to add on 5,000 square feet of new real estate if you're working, semi-remote? It's these questions, they're challenges, but they're, these are trends. I think you just can't ignore them,
Right.
So let me ask you this: what's the vision for your company for the future? What are your guys' growth plans? If obviously further expansion, new initiatives. How do you guys think that you're going to continue building the organization there?
Sure. Yeah, right now, and that's interesting. We're actually going through some strategic planning right now in anticipation of the kind of the next round of, or next phase, I guess, if you will, of buyout, which is actually scheduled to happen next year. And so we're actually going through our own kind of strategic planning and setting the stage for what is that, number one, get to the transition, and then what does it look like, after that. I think number one is we want to make sure that we are developing a path for our future equity shareholders, because I really do think that you're really only as good as the team around you. And if we have great people and they are here with us now and in the future, we have a great team that we can build around. Again, we still are very much, I think, in the camp of organic growth. Let's do this our way. Let's do it, one client at a time in that, so I think, again, I wouldn't close the door to any kind of external type growth, but I think that that's really not on the table right now, per se. And so I think our efforts will be centered around how can we increase our clients' experience? How do we ensure that our great people stay with us, and so that we can really grow, build upon what we've done over the last 20 years, for the next 20 years. And I'm excited about it. I think that things always do change. And I know that, we're in some great study groups and things with other great firms. And, there's so many ways you could go about this. And, I think at the end of the day, each firm kind of has their own personality, and you have to do it your way. I mean, what works for some firms just won't work for others. And so, we're still, to be honest, we're still trying to figure some of that out. We're here now. We realize that we're at this kind of pivotal point where I think there's probably some structural change that's going to have to take place over the next year or so to get us to the next billion in AUM.
Mm-hmm. I like that. Yeah, good.
Mm-hmm.
Yeah, so let's talk a little bit about investments. Are there any specific investments or sectors that currently excite you? And what might be the next wave of wealth creation?
Yeah, I mean, in terms of what, where we see things or trends or anything like that, I think, again, the alternative, access is a big one. Just being able to further diversify an already great core portfolio. I think, with efficient access to things like private equity and private credit and private real estate, I think that trend will grow, and we're already taking advantage of that. We do use some other, I think, a little bit more esoteric types of investments like structured notes, which we really kind of gained some momentum in. And so there are some really exciting things, I think, that really help to build out a more well-rounded, diversified portfolio in the right scenario. We always stick with a kind of a core. In a perfect world, we would all, like to have every client with at least core components of think of just your traditional investments, equities and fixed income, and we'll try to gain access to those as efficiently as possible. That might be through the use of exchange traded funds, institutional mutual funds. On occasion, we would use individual securities if it called for that, and then kind of build out, if necessary, a satellite around that to make sure we achieve their goals. But I think that, there are all types of creative new, products coming to market. And I think you're bombarded with them throughout the day and week and year. It's always a new trend, and here's what's going to, outperform this year. And, we're not a tactical, kind of forecasting type firm. We're not making market calls and saying, hey, for example, of course, we're not saying we need to get out of the market because we think things are going to go down. We just don't make moves like that. It's kind of a fool's errand. But at the same time, trying to be too tactical can work against you as well. You say, well,
right,
this sector is really not primed to outperform in 2024. Let's just get out. Man, things turn on a dime. And making those decisions can really, it causes more harm. More often than not, it causes harm rather than good. And so we try to stay away from extremely tactical decisions like that. So we really try to keep a strategic long-term perspective on it. We want to have exposure to lots of different asset classes, lots of different regions, and things that, we think are going to create a better kind of expected rate of return, but also for the least amount of risk that we can take in the portfolio. So we always have an eye on risk in all the portfolios that we build. But yeah, I mean, it's always exciting, and we're always learning about new things. More often than not, we're not jumping on the next great product or trend because, there's the product side where their job is to sell you something, and then there's the job to kind of invest prudently. And sometimes you're battling that, in an attempt to build the best portfolio for your clients.
Right. So I got a wrap up question here for you. Given your insights on the market and being the CIO, I'm sure this is a question everybody has on in their brains. What's going on with the market, right? We have interest rates that have seemed to plateau a bit. The stock market has been on a more of an upswing this year compared to last year. what do you think the future holds for everything? There's so many people out there, you singing doom and gloom. But the market has, what does Warren Buffett say, has a way of rewarding the patient by taking the money from the impatient, right? And
Very
more
true.
along the lines of being a contrarian in the market, because the market always is looking forward. So what's your
Yeah.
opinion on that?
Well, it's been an interesting market to say the least. I mean, the last 18 months has been a bit of a whirlwind. You went through a 40-year period of declining rates and where
Yeah.
you could just throw money in a bond and you were going to make money because of just price appreciation alone. There was no yield defined, but they were, you were making money on the total return approach. And now all of a sudden, I mean, I've never seen it in my career. I've been in this for 20 years and we've never had any real yield to even speak of. It's just been kind of almost non-existent for most of that time. So now all of a sudden you kind of break through that. You've got this 40-year period, and now you're actually seeing rates increase after all this time. So and I blog about this a lot and I write about this when we do some videos, but it's a violent process to change the guard after decades of one thing. And now all of a sudden you're actually seeing the reverse of that. And you're now seeing normalized rates. These aren't crazy rates. These are just getting back to normal, And so it's a violent turn and it takes time for the market to digest that, which is exactly what's happened. So I think we're going to be just fine. I'm really optimistic about the future. I mean, today we got some really great news. Inflation has continued to kind of cool.
Yeah.
The Fed is they have to have the most thankless job in the world. It sounds like a terrible job. I mean, nothing they do is ever right. But I got to say, I think they've actually navigated this pretty well. I mean, this so far, knock on wood, it looks like we might get through this with a relatively soft landing. I mean, don't quote me on this. I never say this is going to happen or this because I don't know. But it seems as though we might actually get through this without any catastrophic pullback in the market. It's it's very likely, and I think you're already starting to kind of see it, that we will hit some level of pullback. Dare I say recession? I don't know if it'll even be counted as a technical recession when it's all said and done. We probably won't know that for a year later, and then they'll say, "Hey, we were in a recession." That's usually how it goes. But when you have an inverted yield curve like we've seen, and I think it inverted maybe 18, 24 months ago. Well, not that long ago, but at least a year or 18 months ago. You almost always see a recession at some point, and it's usually about 18 to 24 months after the fact. And so, just looking at that, and the yield curve is still inverted today, although less inverted than it was. The likelihood of entering some type of a soft patch or a small recession, it's pretty likely. But look, it's not a foregone conclusion. And, again, it doesn't mean just because it's happened in the past, it'll happen again. But the thing about that is usually about the time you realize you're in a recession, the market's already digested that and it's taken off.
Right.
So
right.
the market is the leading indicator and the recession is lagging. And so a lot of times what you see is the market's leading you out of the recession and your portfolio is doing great, and the job market may be softening and it may be kind of in the midst of this little pullback, but the market won't care. At that point, it's already taken off and those things have already been priced in. I think you can make that argument right now. I think you can make the argument that the market did digest it and it's already starting to move past that. So again, this is why it's so hard to time these things. It's just, it's so counterintuitive. The relationship sometimes even between stocks and the economy over the long, long period of time, they tend to move together, but there's short-term periods where they make no sense.
Right.
You would say to yourself, why is it going up right now? Why is it going down right now? All those things. So I'm very optimistic about it. I think there are really great things to come. Whether or not they're done with rate hikes, you have a lot of people in the media today saying they're done, because now you actually have some pretty sustainable cooling off of inflation. Everything is coming down right now in terms of prices. So that's a good trend. That's what you want to see. And that gives me a little bit more confidence. I think the Fed is going to be, okay with where things are and maybe continue this pause. If not, at some point in 24, you may even see them start to come down, you know? So yeah, it's exciting.
I agree with you there. Thank you for your insight.
You bet.
Yeah, Mike, thank you so much for joining us today and sharing your insights and experiences in wealth management with us. Really appreciate having you on the show today.
Well, thank you guys for having me. I'm happy to come back anytime.
Well, thank you so much. And to our listeners, thanks for tuning in. Remember to subscribe and come back next time for more enlightening discussions on wealth and finance. Thanks, everyone. And thanks so much, Mike.